New York City, January 24th, 2023. The morning bell at the New York Stock Exchange has not yet rung, but the global financial ecosystem is already shivering. A boutique short-selling firm named Hindenburg Research has just uploaded a 106-page dossier to its public website. The target is the Adani Group, a sprawling Indian infrastructure conglomerate worth an estimated $218 billion at its absolute peak. The market opens, and the bloodbath immediately begins. Within weeks, over $100 billion in market capitalization simply vanishes into thin air. Global investment banks panic. Passive index funds hemorrhage capital at historic rates. The world assumes some massive technological failure or catastrophic geopolitical shift has occurred to warrant this wipeout. They are entirely wrong. This is not a story about concrete ports or vast solar panels. This is a story about the hidden plumbing of global finance, accounting alchemy, and the dangerous illusion of paper wealth. It is the dissection of what forensic investigators call the largest corporate con in history. The architecture of this scheme did not rely on complex mathematical derivatives. It relied on a shadowy paper trail stretching 3,000 miles away to an isolated island in the Indian Ocean. To fully understand the execution of this alleged fraud, you must first understand the desperate underlying motive. Infrastructure is a relentless money furnace. The Adani Group builds massive deep-water ports, expansive thermal coal mines, and sprawling solar farms. These hard assets demand billions of dollars in upfront cash before a single cent of commercial revenue is generated. Consequently, the company needs immense volumes of debt. They walk into a Wall Street investment bank. The banker says, "We have the cash you need, but what exactly is your collateral?" The Adani executive points to the stock market ticker symbol. "We are a publicly traded infrastructure conglomerate, and our publicly traded stock is our collateral." The financial math is brutal and simple. The higher the stock price climbs, the more collateral you hold on your balance sheet. The more collateral you hold, the more debt you can legally secure to keep the empire growing at a breakneck pace. By subscribing to Capital Curriculum, you are joining the few who refuse to take the market at face value. You understand that stock prices are not always measures of a company's fundamental health. Sometimes, they are simply tools engineered to extract hard currency from international lenders. Adani needed the highest stock price possible. Between 2020 and 2022, shares in the Adani Group skyrocketed. Some subsidiaries surged over 2,000%. This meteoric rise briefly made Gautam Adani the second richest man on the planet, with a paper net worth exceeding $120 billion. But forensic accountants noticed a glaring anomaly. This growth was not fueled by intrinsic business fundamentals, new revenue streams, or organic market demand. It was a mechanical squeeze. Imagine you own a commercial bakery. You sell 20% of the bakery to the public through stock shares. If you secretly use offshore bank accounts to buy up 19% of those public shares, there is almost no stock left for anyone else to trade. The supply is artificially choked off from the public. Now, if someone wants to buy even one single share, they have to pay whatever outrageous price you demand. You artificially control the entire market. This is the mechanism investigators claim Adani utilized. To successfully orchestrate this squeeze, the company desperately needed a secure place to hide the ownership of capital from regulators. If you want to conceal the ultimate beneficial owners of billions of dollars, you do not keep the money in Mumbai, London, or New York. You route the capital through jurisdictions with strict corporate secrecy laws, opaque tax treaties, and a long history of looking the other way. You need a jurisdiction that allows for nominee directorships, where a hired local citizen can sign the paperwork while the true master remains completely hidden from regulators. You go to the island nation of Mauritius. The Adani Group had to build an invisible bridge between their Indian operations and the global financial markets. They needed offshore entities that looked entirely independent on paper, but operated under their strict control in reality. They needed shells. But setting up dozens of shell companies requires an architect. It requires someone deeply connected to the Adani family who operates entirely outside the boundaries of Indian regulatory oversight. It requires a ghost in the machine. Port Louis, Mauritius, 2020. The humid breeze rolls off the Indian Ocean, rattling the windows of a nondescript office building. Inside, there are no bustling trading floors. There are no armies of sharp analysts studying corporate fundamentals. There are only filing cabinets and polished brass plaques bearing institutional-sounding names. Cresta Fund, Albula Investment Fund, APMS Investment Fund. According to forensic investigators, at least 38 of these Mauritius-based shell entities were directly connected to a man named Vinod Adani, Gautam Adani's elusive older brother. These funds were classic offshore shells. They possessed no physical offices, no independent employees, and no legitimate independent business operations whatsoever. Their sole purpose in the global financial ecosystem was to hold money and move money in complete silence. In a normal environment, a legitimate investment fund diversifies its portfolio to mitigate risk. A fund managing $3 billion will hold stakes in hundreds of different equities across various global sectors to protect its investors. But the funds housed in these quiet Mauritius offices displayed a glaring, fatal anomaly. To fully grasp the absurdity of this anomaly, imagine a private conversation between a wealthy client and a hedge fund manager in London. The client says, "Here is $3 billion in cash. I want you to invest it safely and wisely." The fund manager replies, "Excellent. I am going to put 99% of your money into a single infrastructure conglomerate in India." The client would immediately fire that manager for sheer incompetence. No rational, independent offshore fund places its entire multi-billion-dollar portfolio into a single corporate entity. Unless, of course, they are not independent at all. According to the exhaustive Hindenburg report, funds like the Elara India Opportunities Fund possessed exactly this broken structure. Nearly 100% of their massive capital was deployed solely into the publicly traded stocks of Adani Group companies. To a forensic accountant, this is a blaring siren. These funds were allegedly front entities. They were custom designed to pose as legitimate foreign institutional investors, while quietly taking direct trading orders from the Adani family itself. How does a massive, publicly traded company secretly fund its own stock purchases? They use a sophisticated form of capital flight and money laundering known as round-tripping. Round-tripping is exactly what it sounds like. Stolen or hidden funds are moved out of a home country, washed through an offshore tax haven to completely obscure their origins, and then brought back into the original country disguised as legitimate foreign investment. It washes the money of its true identity. In this scenario, investigative journalists suggest the initial capital originated from the systemic over-invoicing of international infrastructure imports. The Adani Group imports massive amounts of heavy electrical equipment to build regional power plants. But instead of paying a foreign manufacturer directly, the money takes a deliberate detour. The cash travels through a labyrinth of intermediary shell companies, quietly skimming untaxed profits off the top, leaving a trail of wildly inflated invoices in its wake. The money is extracted, scrubbed clean, and prepped for its return journey. The extracted capital leaves India disguised as an inflated business expense. It travels to a quiet shell company in Dubai, hops over the ocean to the British Virgin Islands, and finally lands safely in the lap of a Mauritius investment fund like Albula or APMS. Now the money puts on a new, respectable disguise. The Mauritius fund wires the money back into the Indian stock market as foreign direct investment. But it only buys shares of Adani Group companies. Through this continuous mechanism, Adani was allegedly using its own corporate cash to secretly buy its own stock. The brilliance of the scheme was the psychological effect it had on the broader market. When domestic Indian retail investors looked at the ticker, they saw massive amounts of foreign institutional capital pouring into Adani stocks. It triggered an organic, frenzied bandwagon effect. Retail investors rushed to buy in, unwittingly assisting the manipulation. But hiding ownership was only half the battle. To truly send the stock price into the stratosphere, they had to break the fundamental laws of market liquidity. Dubai, United Arab Emirates, 2018. The relentless desert sun beats down on the concrete docks of the Jebel Ali port. A massive shipping container filled with heavy electrical generation equipment is slowly lowered onto the tarmac. The physical cargo is mundane, but the paperwork attached to this shipment holds the key to a massive capital extraction scheme. An Adani power subsidiary back in India desperately needs this machinery. But instead of buying it directly from the manufacturer in China or South Korea, they purchase it through an intermediary shell company controlled by Vinod Adani, right here in the tax-free haven of Dubai. The commercial invoices are stamped, the numbers are drastically artificially altered, and the extraction begins. This quiet administrative act on the bustling docks of Dubai serves as the fuel source for the entire offshore engine. The excess money siphoned from these deliberately inflated transactions flows downstream into the Mauritius investment funds, transforming into the very capital used to corner the stock market. But secretly buying your own stock through offshore shells does not just create a temporary illusion of demand. It physically alters the supply mechanics of the stock market, leading to explosive, sustained price manipulation. This manipulation requires a strict, calculated evasion of Indian securities law. The Securities and Exchange Board of India mandates a strict legal boundary known as the Minimum Public Shareholding Rule. The rule dictates that for any company to be publicly listed on the exchange, the corporate founders cannot own more than 75% of the shares. At least 25% must remain freely available for the public to trade. An Indian regulator looks at the Adani corporate structure and says, "You are compliant. You own 74% and the public owns 26%. But the reality is completely different. The Adani insider whispers, "We own 74% directly, but our brothers' hidden offshore funds secretly own another 10 to 15% of that so-called public float." The true insider ownership is pushing 90%. The public float is an absolute illusion. The stock is completely and illegally cornered. By quietly starving the true public float down to single digits, the stock becomes intensely illiquid. And illiquidity is a weapon. In an intensely illiquid market, it takes very little actual capital to move the price astronomically high. Think of it like a high society auction for a rare painting, where there are only two active bidders in the room, and both bidders are secretly working for the seller. The offshore Mauritius funds would execute wash trades. Wash trading is an illegal market manipulation tactic where a single entity simultaneously buys and sells the exact same financial instruments to create false, misleading volume in the marketplace. The offshore funds would buy shares back and forth among themselves continuously. By constantly setting higher bid prices in a market with almost no real outside sellers, they systematically painted the tape. They forced the stock price higher and higher with every artificial transaction. This is precisely how a conglomerate carrying heavy, dangerous debt and negative free cash flow was able to magically outperform the biggest technology companies in the world in the stock market. The broader market was not aggressively buying Adani. Adani was aggressively buying Adani. The offshore engine worked flawlessly for years. Between 2020 and 2022, the public valuation of the Adani empire utterly defied financial gravity. But stock manipulation, in isolation, is merely a paper crime. It creates vast paper wealth that vanishes the exact moment you try to cash it out. You cannot use highly inflated stock certificates to buy steel, pour concrete, or build deep water ports. The true genius and the ultimate fatal vulnerability of the entire Adani scheme was how they planned to monetize that paper wealth. They had to cross the dangerous bridge from the shadowy, unregulated world of Mauritius shells back into the highly regulated, sharply illuminated world of global investment banking. They needed to turn ghost money into hard, usable currency. And to do that, they had to convince the smartest bankers on Wall Street to accept their inflated stock as bulletproof collateral. They were about to build a towering house of cards on a highly unstable foundation of recursive leverage. London, 2021. A sleek, glass-enclosed boardroom overlooking the sprawling financial district. Gautam Adani is actively pitching the titans of global finance. Executives from Credit Suisse, Citigroup, Standard Chartered, and Barclays sit quietly across the polished mahogany table. Adani offers a simple, compelling proposition to the bankers. We are the premier architects of modern infrastructure. We are building the undeniable future of global trade. We need billions of dollars in hard currency right now to build it, and we will pledge our rapidly appreciating stock as bulletproof collateral. The global bankers look at the glowing market tickers on their monitors. They see the valuation of Adani Enterprises and Adani Green Energy breaking historic records every single quarter. They see what looks like undeniable, massive validation from the public markets. Blinded by the promise of lucrative fees and the sheer, staggering scale of the collateral, the banks eagerly approve the loans. The paper wealth is successfully monetized. Hard cash begins flowing into the corporate treasury, fueling a massive global expansion spree. The leverage trap is set. This transaction creates a perilous, recursive loop of dangerous leverage. The investment banker says, "Your stock is currently worth $100 a share, so we will comfortably lend you $50 per share in hard cash." The corporate treasurer replies, "Excellent. We will use that $50 to build a new port, pay off older, suffocating debts, and quietly funnel a small bit back through our over-invoicing scheme to keep the stock price artificially inflated." The major banks essentially monetize the fraud. But this entire towering architecture hinges on one terrifying financial instrument: the margin loan. When you pledge stock as collateral, the bank constantly monitors the daily share price. If the stock drops below a specific predetermined threshold, the bank issues a margin call. The banker picks up the phone and says, "Your collateral has lost significant value today. You have 24 hours to deposit $1 billion in cash to cover the difference, or we will seize your stock and ruthlessly dump it on the open market." How did the elite gatekeepers of global finance allow this $100 billion shell game to persist for years without sounding the alarm? The failure was deeply systemic, extending from local, independent auditors to massive global index algorithms. Public companies rely heavily on independent auditors to thoroughly verify their financial health. While Adani utilized established auditing firms for some minor subsidiaries, the sole auditor for their massive flagship entity, Adani Enterprises, was a virtually unknown firm called Shah Dhandaria. According to forensic investigators, this tiny firm had only 4 partners and 11 total employees. The audit partners signing off on the multi-billion-dollar international financials of this sprawling conglomerate were in their early 20s. This incredible mismatch in corporate capability allowed the massive related-party transactions to go completely unquestioned. Meanwhile, Morgan Stanley Capital International, the global benchmark provider, blindly added Adani to its indexes. Millions of retail investors worldwide put their hard-earned retirement money into passive index funds managed by Wall Street giants. Those passive funds automatically bought hyperinflated Adani stock simply because an algorithm told them it was a safe investment. The gatekeepers were asleep at the wheel, heavily sedated by institutional momentum. The entire Adani empire was suspended by a single fraying thread. They had successfully borrowed billions in real, usable cash against a stock price completely inflated by phantom offshore demand. If the global investment banks were ever forced to seize and dump millions of Adani shares into a market that had no real retail buyers, the stock price would instantly collapse to absolute zero. The margin call was the sword of Damocles hanging over the entire conglomerate. For years, the offshore wash cycle generated enough momentum to keep the price climbing and the greedy banks happy. Indian regulators had sniffed around the edges of the Mauritius funds, but the complex, multi-jurisdictional maze proved far too daunting to unravel without international help. The system was highly stable in its corruption. It just required the world to continue looking away. But 3,000 miles away in New York City, a small, aggressive team of forensic accountants had spent 2 full years scraping offshore registries, reviewing court documents, and tracking private flight data. They had found the underlying math. They were finally ready to cut the thread. New York City, the cramped offices of Hindenburg Research. It is late January 2023. A small team of focused analysts stares at their glowing monitors, reviewing a 106-page document one last time. They have taken a massive short position against the Adani Group, betting heavily with their own capital that the stock and bond prices will plummet once the truth is exposed to the world. They hit publish. The dossier hits the global wire services like a localized earthquake. The market reaction is violently swift. The Adani Group loses roughly $50 billion in paper value within 48 hours. The bleeding continues for weeks, eventually surpassing $100 billion. The grand illusion of impenetrable blue-chip stability is shattered instantly. Absolute panic grips the trading desks in Mumbai as relentless sell orders flood the exchanges. The artificial floor, previously built by the Mauritius funds, completely caves in under the crushing weight of sheer, unadulterated market terror. The squeeze has broken. The sudden panic triggers an immediate existential corporate crisis. The Adani executive team is right in the middle of executing a highly anticipated $2.5 billion follow-on public offer, designed to raise fresh, legitimate capital from independent investors. The lead underwriter looks at the collapsing stock price and says, "The open market price has now fallen completely below the target offering price. No one is going to buy these new shares. You have to pull the plug immediately." The Adani executive replies, "If we abruptly cancel the public offer now, it will look like an admission of absolute defeat. It will completely destroy the last shred of our market confidence." But they have absolutely no choice. The conglomerate abruptly cancels the multi-billion-dollar share sale, shocking the conservative Indian financial establishment. But the cancellation of the public offer is merely a surface-level symptom. The real, fatal disease is rapidly spreading through the hidden balance sheets of Wall Street. The margin calls have arrived. As Adani stock plummets by 50%, 60%, and in some subsidiaries 80%, the underlying value of the collateral held by international banks collapses. The ruthless mechanics of the margin loan kick into high gear. Bloomberg reports that major wealth management divisions, including Credit Suisse and Citigroup, completely stop accepting Adani bonds as valid collateral for margin loans. They effectively lock the sprawling conglomerate out of standard short-term liquidity markets entirely. This is a severe containment protocol. The banks are desperately trying to insulate themselves from the widening blast radius. To stave off a total liquidation event, where banks would seize the pledged shares and push the stock to absolute zero, the Adani family is forced into a desperate scramble for hard cash. They must prepay billions of dollars in share-backed loans to rescue their plunging collateral. They begin pulling capital from internal operational reserves and selling off strategic company stakes at massive discounts to friendly sovereign wealth funds just to survive the week. Gautam Adani manages to narrowly save his empire from absolute bankruptcy by stepping in to prepay the massive margin loans with emergency cash reserves. The severe bleeding slowly stops. Vocal supporters of the conglomerate claim total victory, arguing that the mere survival of the company proves the short sellers were wrong all along. They angrily dismiss the Hindenburg report as a targeted, politically motivated hit job designed to destabilize the Indian economy. For a few quiet months, it seems the conglomerate might actually survive the worst scandal in corporate history with its core architecture intact. But Hindenburg was just the initial catalyst. They had successfully identified the Mauritius shell network, but they lacked the final, undeniable piece of the puzzle. They needed the definitive proof of the specific individuals secretly pulling the strings. In August 2023, a global network of investigative journalists funded by international governments obtains leaked internal emails, offshore corporate records, and raw banking statements. The Organised Crime and Corruption Reporting Project is about to reveal the smoking gun. Taipei, Taiwan, and the United Arab Emirates, August 2023. Investigative journalists finally locate the hidden frontmen. The Organised Crime and Corruption Reporting Project positively identifies two key individuals: Chang Chung-ling, a Taiwanese national, and Nasser Ali Shaban Ali, a citizen of the UAE. Both men share decades-long, highly intimate business ties to Vinod Adani. The journalists dig deep into the restricted corporate filings of two specific offshore entities: the Emerging India Focus Funds and the EM Resurgent Fund. For years, these two exact funds traded hundreds of millions of dollars of Adani stock. But the leaked offshore documents reveal a truly shocking truth. The massive capital Chang and Ali were actively trading did not belong to them. The capital is traced backward to a Bermuda-based entity called the Global Opportunities Fund, which was funded directly by a British Virgin Islands shell company controlled exclusively by Vinod Adani. The illicit circle is finally complete. The leaked internal correspondence provides the undeniable, written proof of direct market manipulation. An offshore fund manager sends an email actively asking for specific trading directives regarding Adani stock. The response does not come from an independent financial analyst. The OCCRP investigation proves the trading instructions are coming directly from companies controlled by the Adani family itself. The lead investigator says, this specific document proves that the offshore investment managers were explicitly receiving their daily orders from Adani corporate insiders. The regulator replies, then the systemic violation of the 75% rule is no longer a mathematical theory. It is documented, undeniable fact. Adani money, strictly directed by Adani insiders, was placed into offshore funds run by Adani associates, strictly to buy Adani stock. The smoking gun completely confirms that the largest infrastructure company in India essentially acted as its own primary investor, propping up a massive house of cards to secure billions in international financing from sleeping global banks. When the corporate veil is finally pierced, financial gravity ruthlessly reasserts itself. The global benchmark provider, Morgan Stanley Capital International, is forced into a humiliating, highly public emergency review. They realized that the free float they had based their complex algorithmic calculations on was a complete mirage. They subsequently slashed the weighting of Adani stocks in their global indexes, triggering a secondary wave of massive automated sell-offs. Passive funds around the world take massive financial losses, proving exactly how vulnerable automated investing is to offshore manipulation. The Indian market regulator, the Securities and Exchange Board of India, faces intense global scrutiny for allowing the minimum public shareholding rule to be so easily bypassed for a decade. The mechanics of the Adani con did not require hacking or revolutionary software. It relied entirely on the systemic exploitation of legal grey areas. The extreme opacity of offshore jurisdictions, the absolute blindness of algorithmic passive investing, and the shocking inadequacy of miniature audit firms. The Adani Group survived the immediate liquidity crunch, but the $100 billion wipeout permanently altered the landscape of global corporate finance. It stands as a chilling warning about the vulnerabilities inherent in modern, interconnected markets. The global financial system absorbed the massive shock, but the underlying offshore loophole remains wide open to this day. Right now, thousands of opaque shell companies in Mauritius, the British Virgin Islands, and the Cayman Islands hold massive, hidden stakes in publicly traded equities around the world. Passive index funds are still blindly buying whatever the benchmark algorithms tell them to buy, unwittingly using your retirement money to pump up the artificial valuations of shadowy corporate empires. The next $100 billion illusion is already being built in secret. It will use the exact same offshore plumbing, the exact same margin loan leverage, and it will bypass the exact same sleeping gatekeepers. To successfully navigate this rigged system, you must learn to look past the ticker price and examine the foundation. Subscribe to Capital Curriculum, because the market thrives on your blind trust, and the only true defense against the next corporate con is ruthless financial literacy.